Hi, this is Frank and Josh, wishing you Happy New Year in January of 2023. We're trying a new format this year, communicating with our clients via these videos. We hope to be able to do these more frequently, and as our inaugural one here, we thought we'd talk about the year that we've just completed, 2022, and what our current thoughts are and where we see this going, our best guesses for 2023. If anybody recalls our year-end letter from 2022, we felt like equities were somewhat overvalued, in some cases very overvalued, and the Federal Reserve had made their plans very clear that they were going to be raising interest rates aggressively over the course of the year, based on higher than expected levels of inflation. Both of those thoughts have generally panned out over the course of the last year.
Yeah, I mean, when you think about some of the themes that drove market performance this year, I mean, the Fed is certainly front and center in all of that. And probably, the one thing that the market didn't completely appreciate heading into last year was the degree to which the Fed would have to tighten in order to take inflation down. For much of the prior year, the conversation had been around inflation is transitory, right? And it's going to eventually slow down sort of on its own once supply chains free up and the COVID overhang is starting to clear. And what we found is that post-COVID, that hasn't happened, right? And so the Fed had to be much more aggressive, and the result of that was really a pretty negative year, unusually negative when you think about the degree to which both stock and bond markets were hit in the same year. So the correlation between those two markets was much, much higher than it normally is. Stocks down 19% or so for the year, bonds down about 13. So, the year was definitely, I think, unexpected in that regard and threw a lot of people off. But I also think that it sets us up for sort of a different conversation coming into 2023.
Yeah, it certainly an awful lot of damage has been done, and how much more remains to be done, of course, will be seen. The way I've been thinking about it, bonds versus stocks, now that there's a fair amount of yield back in the bond market, we should be able to get back or closer to a kind of a negatively correlated situation, bonds relative to stocks. And if that comes to fruition, then bonds start to perform their traditional, more effectively perform their traditional hedge role against equity performance. The good news additionally on the fixed income side is there's some yield back.
Right.
The yields across the yield curve are 4.5% to 5%, depending on whether or not you're using treasuries, mortgages, or corporates. Not great in historical context, but as I like to say, better than a stick in the eye.
Right. Yeah. I mean, I think more so than stocks, right? Bonds are more of a math problem, and the math is more in your favor coming into 23 than it has been in a long time. Meaning that if you see a commensurate rise in interest rates this year, similar to the one you saw last year, the return damage won't be nearly as bad because you have this income cushion to fall back on. And that income cushion can be accessed without having to take a lot of risk. So you can own short duration U.S. Treasury bonds and earn, like you said, 4.5% to even more than that on those investments with a very low degree of risk. Now, certainly you're investing into the headwind of inflation, so real returns will not be as high as that. But it's a much better way to pick up income, and the likelihood of having a negative experience in bonds into 23 is much lower than it would have been at this time last year.
And we should highlight as well, as most are aware, our portfolios are heavily tilted towards shorter maturity.
Right.
Just about every portfolio owns 1 to 2 year or shorter U.S. Treasuries, where you're clipping a 4.5% coupon with that minimal price risk relative to potentially higher interest rates. The one other thing that I would say that has been interesting over the course of this last year, referencing what Josh said, is the market has more than once, 3 or 4 times, taken the attitude that, okay, the Fed's done now. They've hiked to 2% or 3% or whatever it was, and the market says, okay, now the Fed's done, the damage has been done, and we can buy stocks. And those periodic rallies in the equity market have not been long-lived and have generally resulted in lower lows being realized thereafter. it feels like we're, to a degree, maybe to a lesser degree, still in that environment as we've had a kind of a rally here into year end. And just yesterday, minutes from the most recent Fed meeting came out, and the Fed has said, no, we're still going. We're still going higher, and rates are going to remain higher for a longer term. So talking about normalizing interest rates, the average federal funds rate over the last 70 years was 4.6%. We're just getting there now. The anomaly in long-term federal funds was the 0% that was maintained since the financial crisis. So we're just getting back to normal. We don't feel like that's overly penal. And I think it says a lot about kind of how we view the year ahead and potential market outcomes.
Yeah, and I think one thing that maybe a lot of market participants don't appreciate is that exact thing, right? I mean, many folks who are in the market today weren't in the market when Fed funds was much higher, right? So the only frame of reference they have is a Fed funds rate that's been close to zero, and conditions that have been extremely loose, so quantitative easing, fiscal policy being loose, right? One thing that people don't really appreciate is with the Fed's dual mandate, right? For the last 15 or so years, they've been more focused on economic expansion on the employment side of that because inflation hasn't been a problem. If anything, they were worried about deflation. Now that has flipped and inflation has become the key issue, and they've made it extremely clear that their primary goal this year and last year was to knock inflation down. And for that to happen, financial conditions have to stay tighter for longer than I think a lot of the market expects to be the case. So what does that mean, right? That means short-term rates and long-term rates probably both have to stay higher. Stocks probably, frankly, have to stay below a certain level because higher stock valuations imply looser conditions. And so the Fed is probably just fine with where stocks are today and maybe a little higher, but are they really fine with an S&P that's up 20% from here without inflation being down?
Probably not.
Probably not. So all of those things factor in, but I think the market, to your point, in the last year has had several instances of false starts, thinking that the Fed was going to be finished earlier than they will be. And part of that is simply because the market didn't listen hard enough to what the Fed was saying.
Which reminds me of another, an adage that we've spent our careers learning, which is don't fight the Fed.
Yeah, exactly.
Yeah. Fed tells you what they're going to do. That's a very dramatic change from when I started 40 years ago.
Right.
You didn't get to see Fed meeting minutes until a year after they transpired.
Right.
And so now they're telling you what they're going to do in advance. All right, so let's bring that into the equity market and talk about kind of what we see there. As already mentioned, we started the year 2022 with what we thought were very high valuations, certainly in the areas of technology, high growth, and those valuations have come down considerably. Right. So better today than they were at the start of the year. I feel like there's still some bifurcation. When we look at some of the higher growth names, the PEs are still high.
Right.
Maybe they can grow into them earnings-wise. Maybe they can't. I think time will tell.
Right. Yeah, and certainly we've had a flip in the way macro conditions are impacting different sectors. So for a couple of years, 20 and 21 in particular, the very loose policy conditions we had favored less profitable growth companies. And so you saw huge run-ups in those types of firms at the expense of more traditional value-focused companies, dividend payers, industrials, things like that. And that's completely flipped here in 22 and going into 23. And I think as long as what we've been talking about with regard to the Fed stays true, and that is that they want to keep it tighter for longer, I don't see why that needs to change anytime soon. I think the momentum still favors more traditional value-focused companies. Less profitable growth companies, I think, continue to struggle in this environment.
Yeah. Earnings and profitability have become much more important in this environment than they were in 2021 and during the COVID crisis. That's kind of how we're oriented anyway. Like to see companies be profitable, still growing, of course, but profitable. Paying a dividend never hurt. Depending on the study that you reference, dividends have made up 50 to 70, even 80% of total stock market returns over time. Right. And part of what we're saying is we can envision that becoming important
Exactly.
again.
Yeah, I think that's a more of a secular shift, right? Where in the last decade or so, the vast majority of returns, both in stocks and bonds, have come from price appreciation, right? So in the case of bonds, lower interest rates. In the case of stocks, just prices going up. The income component is probably more important in the next 10 years than it's been in a long time. So dividends and the interest rate earned on the bond portfolio, I think, drive a larger portion of returns going forward than has been the case recently.
Yeah. And so you'll see a focus in our portfolios on the ETFs focused on higher dividend payers, companies that grow their dividends consistently over time, and the sectors that pay higher dividends as well. I think one other thing on the equity side, in addition to cash flows coming from dividends, I think there are sectors that are more resilient to a recession or a significant economic slowdown. And we're somewhat overweighted to those sectors as well. And think of things like consumer staples, healthcare as consumer non-discretionary as the sectors that continue to do well even as the market slows down.
It is worth spending just a minute on the range of potential outcomes this year, because I think uncertainty is definitely a theme that is front and center this year. It's always there to some degree, probably a little more so this year. And that's in particular with regard to where the economy shakes out. There's a wide range of possible outcomes, ranging all the way from a soft landing where we continue to grow, albeit at a slower pace, down to a more traditional recessionary environment and everything kind of in between. And I think just kind of aligning that with where the market is priced now is kind of important too, because if you look at where earnings projections are and where PE multiples are today, the market seems to be pricing in a soft landing to maybe a very mild recession. So it's important just to kind of keep that in mind with regard to positioning, in that there is some downside risk, I think, still to the stock market if we see a more draconian outcome with regard to earnings and economic growth.
Yeah. No, I agree 100%. And I think the S&P multiple today is roughly 18 times earnings if you take the S&P 500 companies in aggregate. And that's really kind of an average over time. Right. It's not cheap. And I think, referencing what Josh said, that PE relative to all the uncertainties that remain in the marketplace are a concern. Yeah. And I think one of the areas of uncertainty at front of mind for us is geopolitical risk. And the war in Ukraine is an obvious situation that we're all concerned with. Escalation there, or either escalation within Ukraine or potential for expansion outside the Ukraine, could have incredibly dramatic impact on the global economy. Right. And the second area or hotspot of concern for us surrounds China and their COVID policies, increasing levels of nationalism, and from an economic standpoint, they're dramatically over-levered commercial real estate sector. They continue to be able to manage their way through that by easing lending standards and pumping more money into real estate developers that are already over-levered. So, that's a potential house of cards.
Yeah, and that's one reason we haven't been as invested in non-U.S. stocks, right? Is because China makes up a huge portion of that universe. And, certainly short term, it's pretty hard to predict because most of that is going to be driven by the COVID situation and reopening of their economy and how that impacts growth there and supply chains and all of that. But longer term, I think the more secular issues are the ones you're bringing up, particularly the real estate issue. That's never been dealt with, and it's been papered over, and there's a lot of opaqueness to the communication that comes out around that, but it's pretty obviously there. And there's only so long that you can kind of sit on top of that without it having a real impact. So I think longer term, China's a challenge.
Yeah. China and Taiwan in combination are roughly 50% of the emerging market ETF, to put some specificity to how important that region is to the emerging markets. Bringing it back to the U.S., there was an interesting CNBC article yesterday. China is 17% of top line revenues for Apple, and 23% of top line revenues for Tesla. So two, very important stocks within the U.S. market. Apple's obviously the largest by market cap. Tesla, despite the collapse in the stock price this year, I think is still fifth or sixth largest company by equity market cap. So incredibly exposed to China and their economy.
Yeah.
So those are areas of uncertainty. Our portfolios are allocated to reflect these things. We're somewhat higher allocated to dividend payers, dividend growth companies, the sectors that are more immune to economic cyclicality.
Yeah, I think it's important, just to reemphasize the fact that when we talk about these things, our goal is not to try to move portfolios in an extreme way in one direction or the other, right? I mean, there's just too much uncertainty over shorter time frames, whether it's today or any other time. So the idea here is not to be extreme and be out of the market or try to time it or be really heavy in one particular area. It's just to try to use probability to your advantage, right? So take what you know and try to position the portfolio intelligently around that and take out the risk that you're very wrong about something, and that could be damaging to the portfolio.
Yeah, no, that's an excellent point and maybe a good one to end on. So I want to fortify that. Each of you has an allocation that we all agreed upon when you onboarded with us, and we have some portfolios that are as high as 100% equities, and we have some that are as low as 20 or 30% equities. Those overall allocations don't change. But within the overall allocations, we want to be shorter maturity on the bond side and the equity side tilted to some of the variables that we've talked about here today.
Well, so obviously we covered a number of topics here in a brief period of time, but it's impossible to cover all of the topics that people might be interested in. So as always, if you have questions or concerns or thoughts, we'd love to hear from you. We're available whenever you need us. So give us a call, and again, hope everyone has a happy new year.